Most founders think banks don't believe in them. That's not true. Banks believe in collateral, not potential. They don't say no because you're not capable. They say no because their system is built for risk reduction, not business expansion. Let's start with what the numbers say. According to the Federal Reserve's 2024 lending report, only about 38% of new small business applicants were approved for traditional credit. For those under $5 million in revenue, the number drops below 30%. And the main reason, lack of collateral and inconsistent cash flow. Banks operate on formulas. They check your debt service coverage ratio, your DSCR. They want at least 1.25. They look at 2 full years of profitability, strong personal credit, and tangible assets they can recover if something goes wrong. If you don't fit that model, it's not personal rejection, it's regulatory compliance. Here's the problem. Service businesses rarely have hard assets. Your value lives in your people, your contracts, and intellectual property. None of those can be repossessed. So you can be profitable, reputable, and still unfundable in the eyes of a bank. That's why I tell founders to stop taking no as an insult and start reading it as not our product. Banks sell safety. You need speed. Let me give you an example. A client in professional cleaning applied for a $250,000 expansion loan. They've been profitable 6 years in a row, but because their equipment was leased, the bank viewed them as asset light. Denied. We helped them raise $400,000 through a Reg D with private investors instead. 2 investors, both former clients, funded in 30 days. They scaled operations by 40% inside a year. Same credit score, same financials, different capital source. That's the future of small business funding. Let's look at where capital really is today. In 2024, Regulation CF crowdfunding surpassed $800 million in total raises. Platforms like WeFunder, Star Engine, and Republic allow you to raise up to $5 million a year from the general public. Service businesses now represent roughly 20% of those offerings. That means local trades, agencies, and professional firms are learning to use investor capital without Wall Street or banks. There's also a growing market for revenue-based financing. Instead of fixed debt payments, you pay back a percentage of future sales until the amount plus a fee is repaid. It flexes with your revenue cycle and doesn't require collateral. So the next time a banker says, "We can't help you right now," translate to, "We can't take that kind of risk." That's fine. You can find investors who will. Now, before you approach any investor or platform, you need to get investor ready. That means 3 things: clean, current financials, proof of customer traction, a clear plan for use of funds. Investors don't want to see a spreadsheet full of hope. They want to see how each dollar generates a return. If you tell a banker you need $250K to grow, they'll ask, grow how? If you tell an investor you'll deploy that $250K into a defined system that produces $3 of revenue for every dollar you spent, you'll get attention. This is where professional presentation matters. Create an investor brief, 1 page that outlines your business, financials, funding target, and projected ROI. Show predictability, show leadership, show math. Now let's talk mindset. Many founders feel safer borrowing from banks because they think it's cheaper. Sometimes that's true on paper, but not in opportunity cost. If waiting 6 months for an approval means missing 12 months of growth, you didn't save money, you lost it. According to the SBA, businesses that secured capital in under 90 days grew 27% faster in the following year than those that waited for traditional loans. Speed matters. So what's the practical next step for you? Start building relationships with alternative capital sources before you need them. Crowdfunding platforms, angel networks, accredited investors, even your own client base. Educate them about your business now. So when you're ready to raise, trust already exists. And here's the twist. Banks will often lend to you after you raise investor capital because now you have liquidity, cushion, and confidence. Funding begets funding. If you're a service business owner waiting for bank approval, stop waiting. Explore regulated alternatives that reward growth instead of punishing it. If you need help building that roadmap, visit webinar.capitalraisingacademy.com and join our free masterclass, How to Raise Capital the Smart Way Without Losing Control of Your Business. It'll show you exactly how to move from not qualified to fully funded. Banks exist to protect themselves. You exist to grow your business. Those goals rarely align. Build your own path to capital.